We're going to be talking about the most popular tax structures that wealthy people use to protect their assets, specifically their luxury homes. Now, the biggest one is the step up in basis tax clause. The simplest way to put this is if your family bought a home, let's say for $500,000 30 years ago, and you get left this nice home in a revocable living trust for, let's say, now $5 million, you do not pay capital gains on that home as long as it was left to you within a revocable living trust. What the step up in basis tax clause really allows is all that property that gained value during the time of your parents' or grandparents' ownership is wiped clean, and you take value at the stepped up basis tax price. So let's say you now inherit that home for $5 million, but instead of deciding to sell it immediately, you keep the home for another year, and let's say it gains value of $300,000, and then you decide to sell the home for $5.3 million, you would pay a capital gains tax on the $300,000, but not the $5 million. So this is really the biggest secret tax code that the wealthy people use to keep wealth within the family. So it's not just about preserving wealth for the original owner, it's about preserving and protecting your family's future for multiple generations. Now, another well-known trick used by wealthy landowners is to buy multiple parcel land purchases, or what's called a multi-parcel land sale. These are also typically purchased under a revocable living trust and often protected under an LLC. Now, the reason they're protected under an LLC is a lot of the times these people own very large family businesses, and to protect from a lawsuit, an LLC literally limits your liability if you were to be sued. So you can't be sued for like all your property, all your bank accounts. They can only sue the actual physical business itself. Now, the one thing that luxury properties different from regular properties is people also typically own other rental properties. So as long as those properties are income generating, you can offset the profit from those properties on your property taxes on your primary residence. Now, the one loophole people miss is you can't just buy a second or third property and not have it be income generating and write off the taxes. It's only if the property is lived in as a rental property or for a business use. You can't simply buy a second home and write off depreciation. So that is the biggest tax clause. It's what's called depreciation. It's basically if you buy an apartment complex, a business complex, and it's income generating, you can divide the property, not the land, for 27 and a half years. So a $30 million property, you can essentially write off $1 million per year off of your